Hi. So in this video, we're going to put it all together here, and now you should start to feel like you have a pretty good toolkit about this. We've gone through time value of money, discounting cash flows, net present value, all of those ideas. We went through beta in the last video. So this one is what we call CAPM for short, the Capital Asset Pricing Model, right? CAPM, CAPM is what you say for short. And what the capital asset pricing model does is it takes beta and expands it out to basically quantify risk, right? That's what the model's doing. And then translating that quantified risk into an estimate of expected return on equity. So it's like with this type of risk that we've calculated by beta, how many measures of market risk a particular stock is going to move relative to the market, right? That's going to take that and turn it into what kind of return should we be expecting for investing in a stock with that type of risk profile. So this is it. The required return on equity and this is the CAPM formula, right? So CAPM, whatever you want to call it, this is the required return, right? Is the risk-free return, right? And that, as we talked about before, is U.S. Treasury bonds. And you can look those up and see what the rate is now. But we estimate right now around 2% or so. So it's the risk-free rate plus beta times the equity premium. Remember we talked before about the equity premium, right? And we said that that's around 5.5%. Your assumptions on both the T-bonds, the Treasury bonds, and the equity premium could be different. But as long as you explicitly say what your assumptions are, then other people can understand where you're coming from in your calculations. And so those numbers could then be bought into or, sort of argued about, bantered about until you come up with things that people agree on. That's really the key with these formulas, is that you are in a spreadsheet or something, putting out all the numbers, all your assumptions, and then here's what the calculations conclude. So no one can really argue with that, right? You're actually making quantified decisions using the numbers. So let's run an example, right? Now that we've got this, and this you already know this stuff. So beta, we're going to say, remember in the last one we did a beta of 2, right? So beta of 1.7. That's still a high beta, right? That's higher than the market. A beta of 1 would be moving exactly in sync with the market. So this actually is a levered stock where, as the market moves up, the stock's going to move up more. As the market moves down, the stock moves down more. So it has more volatility than the market. And the risk-free rate, we're going to say, is 2%, beta of 1.7, and our equity premium of 5.5%, right? So then the CAPM is going to be 2% plus 1.7 times 5.5%, right? So that comes out to be, do the numbers, right? Do that calculation, and you should come up with 11.35%. So that is the rate of return that we would expect to get from a stock, investing in a stock with a beta of 1.7. And as I said before, too, you can find these numbers on whatever your trading platform is. If you have an E-Trade or Schwab account or Robinhood, and when you look up a particular stock, one of the numbers it'll give you is the beta. So you can do it that you can actually just look at that number and see, oh, this stock's more or less risky than the market. And now what we can do is we can take this number here, right? This expected return becomes the discount rate. This is a way to quantify what discount rate you're going to use in your discounted cash flow equations. And so CAPM equals the discount rate, right? So when you're doing discounted cash flows, right, discounting getting the present value of future cash flows, that's how you value a stock, that's how you value any income producing asset, right, is going to be, okay, like rent on a house or whatever it's going to be. If there's income producing from an asset like a stock, then what are those free cash flows? And there's another video on how do you calculate free cash flows, basically net income, adding back a few or taking away, making the adjustments from the cash flow statement to get really what is the cash that's available for use. Free cash flows in each year. and that is divided by 1 plus the rate, and in this case the R equals CAPM, right? So in here we'd be putting 11.35 and to the power of what year that is, right? So, and we've done this before in all the future value calculations, present value. Net present value is basically taking the present value of future cash flows and then subtracting how much it costs you to get those cash flows. And then if the present value minus the cost is a positive number, it's a good deal. If the cost is more than the present value, if the present value minus the cost is a negative number, right, then it's a no-go. It's not a good deal. So here we're doing the present value of these cash flows, and in each time this will be CAPM, right? And in the second year it's squared, cubed. In the fourth year it's to the fourth power, and on and on. Usually you put a terminal value after maybe year 5, right? And that sort of takes into account what the value is in the future ad infinitum, because stocks can be around for 50 years, 60 years, 100 years. A lot of companies, General Motors, something like that. These companies have been around a long time. So you're actually pulling back that whole estimated, future cash flows, because obviously we don't know what they're going to be. So it's our estimates pulled back to this year. And that's what stock analysts do. That's what hedge fund guys do. That's what private equity folks do to figure out can we acquire a company and take it private if it's a public company? And here's what we think the present value is. Other people think it's less than that. So we think that we could manage it in a way where we're going to make a premium on it in some way. That's what every kind of trade is done. This is the formula. And even when people buy stocks, right, if they're just guessing, basically, they're still in their minds kind of doing this kind of calculation. Well, that stock's going to be making money and it's going to make more money in the future. And we pull that back to present value dollars. Oh, it's a good deal. I want to get in that stock. That is, and basically all of those different trades, it's called the wisdom of crowds, right? All those different trades aggregated together, that discovers the price. Like I said before, markets are price discovery mechanisms. So this is the kind of formula that we're doing, and we're using CAPM as that rate of return. So I hope this is all starting to make sense to you, and it's like, wow, CAPM, you always thought capital asset pricing model, that sounds very complicated and all, but it's really not, right? It's basically just beta times the equity premium. We fix that, and T-bonds, you look them up, and get 2 is a good number to guess on right now anyway, or to estimate. And then it's a very, very simple formula, right? So now you have another tool in your toolkit. And I tell you what, if you know this kind of stuff, if you understand this, you're going to have such a leg up on all the people that you're competing with in your career and things. These are the type of things. And in your private life too. If you start investing in real estate, you can do this kind of calculation, see how much the rent's going to be each year, pull it back. Is what they want for the house less than what you think these numbers are going to be? Then buy it. If the number is twice what you think the present value of the cash flows are, it's not a good deal, right? So you can start to make those type of calculations as you build up your own investment portfolio and as you build your career. This stuff is just really, really great to know, and not a lot of people know it. So congratulations.